Thank you all for joining me here today. My name is Michael Reid. I'm a senior economist with Oxford Economics. It is 9:30 a.m. and give yourselves a pat on the back for signing up for the Economic Outlook session here. A little bit about Oxford. We are a economic forecasting and modeling company. We provide consulting and information services for a range of various clients throughout the globe. Our main piece of information that we produce is our global economic model. This is very valuable to us because it incorporates multiple components of global trade as well as regional economic activity. So we'll get a little bit into that today. A quick background about me. I've been with Oxford for about 5 years now. Prior to that, I worked at the Bureau of Economic Analysis, which produces the GDP estimates here in the U.S. I worked there for about 5 years, and before that, I worked at the Center for Labor Market Studies. So for the presentation today, we're going to go through a few things, and I'm going to put a big asterisk up here because I'm sure there are a lot of questions around what's going on with the coronavirus. I'll throw that out there right away. There will be some slides for that. So if you have any questions regarding that, just try to hold those off for later. We're really going to start off with some work that Oxford did with the National Fluid Power Association a couple years ago, looking at a regional demand model. We'll then look at the global macro context for what's going on in the economy right now, see how that's impacting U.S. activity, both at the national and regional level. And as I mentioned, we'll have some key takeaways, and I do have some slides on the coronavirus because that is altering our outlook at the moment. So the regional demand model that we built for NFPA was really a way to contextualize and put some hard numbers around who and where fluid power is being purchased in the U.S. We did this using input-output tables. Really, those are just inter-industry relationships. Those look at who's purchasing inputs from whom in the national accounts. Okay, we looked at this for the U.S. overall in all 50 states. We looked at this back in 2018. And so you're aware, if any of you are involved with NFPA, we are updating this at the moment, and we'll look to have a 2020 update coming out towards the end of this year. Really, the goal here is to help you all understand what the market looks like here in the U.S. And maybe just to help me get some context, by show of hands, how many folks here are in sales or marketing? Okay, a couple hands. How about engineers? Okay, quite a few. And then how about planning or strategy? Okay, so this will be relevant for all of you, but you want to use this in different ways. So starting with a high-level perspective, we estimated the three main industries that produce fluid power, and we looked at those industries that purchase from those fluid power industries. And overall, we found in 2018, it's about a $28 billion industry here in the U.S. Now, this includes both domestically produced fluid power as well as imported fluid power products. And we wanted to include both of those because that's a key way. If you're based here in the U.S., we wanted to make you aware of opportunities perhaps to move into areas that you were not servicing before. I'm sure this is not a surprise to you looking at some of the vendors out here today at the expo, but you have machinery manufacturing coming in on top and followed closely by transportation equipment manufacturing. Those represent really the lion's share of the demand for fluid power. But looking at some of those smaller niche manufacturing industries, primarily you have some of those that are just coming in under $1 billion. such as, paper manufacturing, asphalt and basic chemical manufacturing, and so on and so forth. So what I'm going to do today is present a couple of these that I've selected, starting with machinery manufacturing. But before I get into that, just again, high-level overview of where people are purchasing fluid power products. This is a map of where the products are being used. So should be no surprise, California, Texas always tend to show up there. But you also want to concentrate in the Midwest, states like Michigan, Ohio, Indiana, and of course you have Washington there. As I mentioned, Texas is certainly the biggest. We'll see a bit later on that really accounts for most of the oil and gas extraction activity. California is represented across the board, should be no surprise. Ohio, you have a fair concentration, as we'll see, in machinery manufacturing, and Michigan, rounding out some of the top states, Michigan, auto manufacturing. So those we'll talk about a little bit. So looking at the first top industry here, machinery manufacturing, that's about a $10.8 billion market in 2018. This looks very different from that national map I showed you earlier. And that's because the companies that manufacture machinery products are concentrated in the Midwest. So these states here that are shaded in darker blue, that's where your machinery manufacturing base is, okay? Now, you also have Texas and California represented there, but I think the key takeaway is that the Midwest is a place to be if you're selling into machinery manufacturing. Now, in terms of, some key economic indicators that you'll want to keep an eye on if this is your key customer base, includes things like the ISM new orders and core capital goods. That excludes aircraft, so that would exclude things like aerospace manufacturing. What we've seen recently is that these indicators have moderated a bit, and as I'm sure you're all watching, this index is going to change very rapidly in the coming months. So this is a good one to keep an eye on. This is a leading indicator for the economy. As data comes in, these particular indicators can move the market. Looking ahead through 2020, we are revising this again, but prior to the outbreak here of the coronavirus, we did see that business investment was likely to stall a bit. That's not to say we expected a recession. Things were slowing down. They were cooling. The U.S. economy overall is going to grow perhaps about 1.7%, and we'll talk about why we're going to revise that down later. But again, some of the key things to look at here include business investment, and you can see in our forecast in the lower, it would be your right-hand corner. It was taking a bit of a dip in our forecast coming out. That's going to be prolonged now. Looking at another industry, transportation equipment manufacturing, that represents just under $10 billion of demand in the United States, again for 2018. And you'll see here the map looks notably different. So if this is your primary market, your focus should be on Washington and Michigan. Should be no surprise. Now, some of the key indicators that we look at for this particular industry would include consumer confidence. Why is this one important? When consumers have money, they like to travel. And I'm sure, as you've all seen on the flights were pretty empty today. So consumer confidence, while it's been increasing recently, we've had a great expansion coming out of this Great Recession. We're facing quite a bit of headwinds right now. The unemployment rate is still low, meaning people have jobs, they have income, they're spending money. But what happens when you have a situation like this is they're going to pull back and they're going to wait. So they may delay things like that vacation out to Las Vegas, down to Florida. And that's going to impact how these transportation equipment manufacturing companies plan for the future. Similarly, looking at another indicator, we have light vehicle sales. And again, there we see that really the sales are going to plateau, meaning they came out of the Great Recession quite strong. There was some pent-up demand. People weren't buying a lot of cars. Perhaps they were using cars for a longer period of time, weren't looking to upgrade. But now that peak demand has passed. So right now we are at or near full employment, meaning most everybody who wants a job has one, and those people are going out and they're spending their income, but they're not going to go out and buy a car every year. So here we see that the demand for vehicles might moderate. Now I will say that one thing that may change, and this would be very interesting to keep an eye on, depending on how this coronavirus develops in terms of public transportation, there may be a slight spike in demand for vehicles, especially for folks who rely on public transportation to get to work, myself included. Of course, there are telework options, but I would be interested to keep an eye on this. As I mentioned, the global and even U.S. travel is going to be disrupted because of this outbreak. We think that this is going to be quite significant, both for airlines, for airports, and this is really going to affect their operations. We've seen a couple of smaller airlines already close up shop, but none of the major players. So I wouldn't worry about that. But a key thing to understand is this may delay their need for purchasing and upgrading their equipment. So whether they put that off for a month, a quarter, maybe half the year, a year, is yet to be seen. But in terms of what we are seeing right now, China represents a significant share of tourism spend here in the U.S. So having that travel, that ability to have those people come and visit. Also, you have a lot of folks from Europe, and that's now closed off. That's a lot of money that comes into the U.S. economy that gets spent. That's no longer going to be here for the next few months. So perhaps turning to an industry that is less reliant on the global economy and more reliant on the domestic economy here, we have construction equipment manufacturing coming in at just under $3 billion in 2018 in the U.S. Now this one looks much different than the prior two maps. You'll see California and Texas stand out. And really, this is because construction is very correlated with population. So where you have large amounts of people, whether it be for building homes or apartment buildings or office buildings in which they work, it's really a function of population. So your big states, California, Texas, Florida, and New York, are going to be the primary centers for this. Again, we've seen some slowing demand in residential construction the past 2 years. That's not to say it's in any kind of contraction. There's a lot of pent-up demand there. And I think we all saw that coming out of the Great Recession. A lot of folks lost their homes and are trying to get back into the market. And you also have a lot of folks who held off getting into that market. And we hope that they've been, saving up, perhaps living in their parents' basements. I'm sure you've all heard the stories out there. But they're saving up and they're looking to get out and soon purchase their own home. So this is one to keep an eye on. This may be a bit stronger than some of those other two industries that we've looked at. Another key factor to keep an eye on that really helps promote demand in this sector is mortgage rates. And those are really a function of what's going on with the Fed. So right now, the Fed has actually cut the federal funds rate by 50 basis points We expect that might happen again in the near future, perhaps another 25 basis points. So that's going to be a good thing for the construction industry in that it's going to push down mortgage rates and make those, mortgage commitments from people entering the housing market a lot more appealing. You also have some refinancing activity or perhaps some folks who might want to remodel if they've been saving up for that. Another key factor that I mentioned is we've seen a lot of that, strong income growth over the past few years. While that's not going to continue to be as strong, it's still something that we think is a key tailwind for the economy. A lot of people have jobs, they have incomes, and they're going to want their own homes. Here, as I mentioned, it's one of the key things to look at is population growth, but we also want to look at growth in household formation. And what that means, it's people creating new homes, whether they move in with a significant other, move out of their parents' basement and get their own home. And if you look at this map here, this is more at a county level. Should be no surprise, though, that we're seeing those counties in red having the greatest household growth in the next couple of years, whereas the areas in blue don't have as good of an outlook. Coming from New York, I can tell you a lot of people leave there when they retire just because it's cold, it's expensive. They go down to places like Florida. Arizona's become a popular destination. You can also see up in the Northwest there's been a lot of household growth in states like Oregon and Washington that have had strong labor market growth. Switching it up, I picked some of these smaller industries just to take a look at. As I mentioned, oil and gas extraction, that's got about a $300 million demand here in the U.S. That's concentrated in Texas. That should be no surprise. So if you're selling into this market, I think most of your activity will be in Texas, perhaps a bit in Oklahoma, Pennsylvania, but Texas is by far the standout state. Now, there are a few things going on in the oil markets right now. One of the key factors is OPEC. They're having some disagreements internally, and that's really pushing oil prices down right now. That actually can work against U.S. producers. They need a certain dollar value per barrel to be profitable here in the U.S. So when you have some shops that are out working in the Marcellus Shale region, for example, if oil falls below, say, $50 a barrel, they may cut production. So this is something to keep an eye on. But also, more importantly, I think the OPEC negotiations, I believe Russia in particular is not in agreement with what's being talked about by some of the other countries. So on that front, that's a little bit out of the control of the U.S. But one thing that's been buoying the economy here in the U.S. is that we've actually produced so much oil here, we've become an exporter. So if there is some amount of turmoil in the global markets, we do have the ability now to export that, and that's going to add to GDP. So again, here, this is an indicator if you're selling into this market to keep an eye on. Now, lastly, I picked perhaps what I consider more of a fun one, food and beverage manufacturing. Again, a relatively smaller market, but just to give you a sense of some indicators of what's going on and what to look at, we have about a $200 million market here in the U.S., primarily concentrated in California. This is going to follow, again, trends in population just by sheer size. But there's also some amount of supply chain connectivity, in terms of where people are sourcing their food and then where it actually gets manufactured and produced. So for indicators to follow, you're going to want to watch income growth and consumer spending. As I mentioned, we're relatively confident about those in the near future, given that unemployment's been so low and we've seen incomes rising. Those will continue to have upward pressure because the number of people who are able to enter the labor market here in the U.S. Is going to decline. So that's going to put upward pressure on wages, especially at the lower level. And regardless of your income level, everybody needs to buy food. So this is really a good one to watch. This one will have less of a fluctuation in demand over time relative to some of those other industries that we looked at, such as transportation equipment manufacturing or construction equipment manufacturing. So with that just wraps up the couple of the maps, the regional demand model. I'm going to move into the global macro context. But before I do, I just wanted to open up the room to questions at this point on the regional demand model. No? Okay, great. Again, we'll have an opportunity at the end for any general questions. So the global economy, what's going on? It's kind of hard to answer right now, but what we've been seeing is that there's been a synchronized slowdown, and that's across all economies around the world. You can see that looking at some of the countries here in the G7, U.S., Canada, U.K., Germany, across the board, we think all of these countries are going to slow. The U.S. perhaps is performing a bit better relative to our friends over in Europe, but everyone is seeing the slowdown. We did have some encouraging indicators, as I mentioned. We had some really strong growth in business investments. We had strong growth in labor market activity, but then this coronavirus thing hit. And this is really changing the way that we're forecasting our outlook, both for the U.S. and for the globe. And it's really difficult. I'm not a doctor, but looking at this chart, we have a few things that stand out. First, the number of cases that are occurring, they're spreading rapidly. In fact, I had to submit this presentation over a month ago, and when I submitted this, we had the same slide. The number of global cases was just under 40,000, so it's doubled in a month, and I'm sure that's even higher today. Since I woke up this morning, the NBA got canceled. I think the good news is, though, that relative to some of these other outbreaks, we've seen the mortality rate is quite low. So there is this belief that we can fight this by putting in some of these preventative measures. But what that means for the economy is that things are going to get put on hold. And I have a slide, I think perhaps later on I'll show you what I mean by that. But right now, our outlook, and again, this may be revised down even more because of what's going on in terms of these travel bans, this economic activity that's being closed. As I mentioned, we've seen the NBA suspended season. March Madness is going to be played in front of empty arenas. That's going to put a damper on economic growth. People aren't going to be going out. They're not going to be eating at restaurants. They're not going to be spending money on apparel at these events. So that's really going to be a drag on the economy. Right now, we previously, before this outbreak, we had forecast U.S. growth to be about 1.7% annualized for 2020. We've revised that down by 4 basis points here, and I think that's going to come down quite a bit. But looking at some of these other countries where the outbreak's been notably worse, for example, over in Asia, China, we think things are going to be quite difficult there. So we've actually revised our outlook for China down by 1.4 percentage points, which is quite significant for an economy of that size. And I think I alluded to this earlier, but what we meant by our outlook changing is that it's going to be a very binary outlook, meaning that if things start to shut down, we're going to revise our outlook all the way to zero, because if things stop happening, economic growth is going to come to a halt. And again, this may not necessarily be a recession. A recession has to be 2 consecutive months of negative growth coupled with sustained unemployment. So we don't expect to see that. That certainly could happen. But for now, we think if this is contained within a quarter, we're really going to see the impacts of this coming out in the next quarter or so. You're going to see very little and perhaps negative growth in many sectors. So moving back to the U.S., what do we think? Well, as I mentioned previous to this, we saw the U.S. is generally cooling. That's a trend that's occurring throughout the globe, but the U.S. was doing all right, coming in just under 2%. We've had a very strong recovery since the Great Recession. We've had a record 126 months of consecutive growth. That may actually come to an end. So don't be surprised if that happens, but also don't worry. As I mentioned, the ideal situation will be that it's a temporary halt, not a continued halt in economic activity. It's also been the slowest. So the fact that we were forecasting a sub 2% growth for the U.S. Shouldn't be a real surprise. The way things that have grown out of that Great Recession have been more moderate compared to previous expansions in the past. And I think that's for a couple reasons. But some of the key things to keep in mind are that people are being a bit safer about their business planning and strategy. We've seen trends of especially manufacturers move toward lean manufacturing. So a key indicator looking at the next couple months is going to be inventories. We also have some other indicators that you can look at. We have what we call soft indicators, and those are more surveys or when you ask, for example, executives at companies what their outlook is. I don't put as much weight as those on those relative to the hard indicators. Those are things like, I don't want to get ahead of myself. These are some of the soft indicators. So we have the CEO Economic Outlook Index, and we have the Small Business Optimism Index, for example. These are just asking those businesses, what do they think? What's their plan for the next few months? And these have moderated in the past couple months, and I'm sure as these come out, these are going to go negative. I think everyone's going to be a bit nervous. But again, don't put too much weight on that because what really happens in the economy depends on how people behave and what they do. So some of the harder indicators that we like to look at, as I mentioned, include payroll growth. We've had really strong payroll growth the past couple months. In fact, the latest one came out in February, exceeded, I think, most everyone's expectations, came in around 275,000. Now that may moderate, but again, if people have jobs and they have income, the great thing about the U.S. economy, it's largely consumer driven. About 70% of the economy relies on that. So if people have jobs and they have money, they're going to go out and they're going to spend. As I mentioned, this is just looking at GDP growth and the contribution to that growth. So if you can imagine each of these bars representing some of those big bucket items. I don't know if any of you took Economics 101 back in college, but C plus I plus G plus X minus M, right? This is kind of what we're looking at here. And in the red, you'll notice the red stands out. As I mentioned, that's the consumer portion, the C part of GDP. And here in the U.S., that's about 70% of GDP. So given that we have a strong labor market, strong growth, that's going to help sustain the U.S. economy better than some of those economies we were looking at before, both in Europe and some of those emerging markets over in Asia. In terms of regional economies in the U.S., I'll talk a little bit about what's going on here. We see some strong spots for growth in the U.S. In the next couple of years, really concentrated in some of those areas I've mentioned before, Washington and Oregon up in the Northwest. Of course, California is always showing up there. You have the oil-producing regions down in Texas, and you have the Northeast corridor. Things aren't going to grow or do as well in the Midwest generally. That is because there's a manufacturing slowdown that is occurring. And we do see some risks, especially supply chain risks, because of this coronavirus outbreak. So that's one thing to keep an eye on. You know, in terms of what's driving growth, we see the information sector as really leading the way. But you can see here, many of the service sectors are what drive growth here in the U.S. economy. And as we mentioned in the previous slide, some of those areas that are more concentrated in manufacturing are going to lag. So if you look at this on kind of a regional basis, comparing, say the Pacific all the way over to the Midwest, the composition of their respective economies in terms of the industries represented there looks quite different. In fact, you can see in the Pacific that light blue bar, second from the bottom, that's information. So that's going to pick up basically Silicon Valley. So you can see relative to the rest of the country how important that sector is to the Pacific. And because that sector is doing, we expect that to do much better in the near future. That's going to help the Pacific region perform better relative to some of these other sectors, or the other regions that are more reliant on other sectors that won't perform as well. As I mentioned, there are some manufacturing hubs at risk. So this map is a heat map showing the concentration of especially traditional manufacturing hubs here in the U.S. This is where we expect growth to lag some of the other sectors. So places like Michigan, Indiana, Ohio, Kentucky, they're going to be they'll be hit a bit harder, especially if there are supply chain disruptions because of this coronavirus. I will say we do have a research brief that is forthcoming where we actually evaluated intermediate inputs coming from China into specific sectors of the U.S. That rely on those inputs for production processes, and we map those to states. It doesn't quite look like this, but you can imagine it looks very similar. So as those sectors, as they draw down on any inventories that they do have, hopefully they have some, as those get drawn down, if they're not able to access their supply chains over in China, you're going to see quite a bit of disruption, especially here in the Midwest region in red. So some key takeaways. We already saw manufacturing activity as being relatively weak compared to some of the other sectors of the economy for our outlook. And unfortunately, this coronavirus outbreak is perhaps going to worsen that. There are some bright spots. There were a couple sectors that are more reliant on kind of advanced manufacturing in the Pacific Northwest region. So you can see on the chart on the left, some of those states like Oregon, it's doing a bit better in terms of manufacturing activity compared to some of your traditional hubs in the Midwest. But that's not to say they could also be interrupted in their supply chain as well. Especially for folks like yourselves who perhaps are selling fluid power products to these manufacturing industries, automation may be a good thing. And that's not to say we think it's great for the economy. That's still yet to be proven. But what is automation? What does it really represent? Automation represents a transition from labor to capital. So as some of these manufacturing companies look to automate their processes, that may help folks like yourselves who are selling fluid power products. They're going to become more reliant on capital, more reliant on machinery. So that could be an opportunity, across all industries. So, the key takeaway here is if you look at industrial production here in the U.S., you see that's been on an upward trend compared to manufacturing employment, where we've seen quite a bit of a downward trend. I can't tell you at this point, given what's going on with the corona, if that's going to be exacerbated just yet. But long-term trends, we expect this to continue. We think that manufacturing employment will continue to decline. That's not to say output will decline, though. So just tying this all together, in terms of some of the key indicators that you want to keep an eye on if you're investing or selling into any of these key sectors that buy fluid power products. For machinery equipment manufacturing, you want to look at indicators such as industrial production or purchasing managers index. For transportation equipment, you keep an eye on things like trade, tourism, and wage growth. For construction equipment manufacturing, you're going to want to keep an eye on population and household growth as well as income growth, especially on a regional basis. For oil and gas, keep an eye on commodity prices, oil especially. And lastly, for a sector like food and beverage, again there you want to keep an eye on consumer spending and inflation.